You think Nvidia posting another massive revenue beat is just a victory lap for hardware? But Wall Street is actually using those numbers to reprice the survival of the entire software sector. Nvidia just delivered $68.1 billion, proving the physical build-out of artificial intelligence is still accelerating. That capital is now flowing straight into software companies, proving they can actually monetize these models. But rising energy costs tied to global geopolitical risks are quietly threatening the cash needed to run these networks. Stick with me, and we'll track exactly where your portfolio cash is moving today. Nvidia hit $68.1 billion in fourth quarter revenue. The crowd is cheering the massive 73% year-over-year growth. Your portfolio actually cares about their 75% gross margin. That margin proves hyperscale companies are forced to pay whatever Nvidia demands for inference computing. That extreme pricing power forces heavy capital expenditures to continue bleeding out of the buyers' balance sheets. If you hold the mega-cap buyers, their free cash flow is taking another heavy hit. Remember that infrastructure costs show no signs of slowing down. Anthropic just announced new application integrations, and software stocks rallied hard across the board. The retail narrative says artificial intelligence is finally playing nice with legacy systems. The actual math shows existing software companies are actively building protective moats around their recurring revenue. Integrating these models means legacy platforms don't get replaced by them. This aggressively defends their operating margins from being cannibalized by startups. Your enterprise software holdings just protected their future cash flows from sudden obsolescence. Legacy software is adapting instead of dying. Salesforce proved this margin defense is a reality right now. They reported $800 million in annual recurring revenue exclusively from their Agentforce platform. The anchors are completely distracted by the overall revenue beat. The real signal is that 29,000 autonomous software deals closed in a single quarter. They're successfully charging premium pricing for new software without hiring thousands of new human workers. That directly expands their operational leverage. Software providers are converting expensive compute into actual dividend-paying cash. Monetization is finally happening at the application layer. Energy markets are waking up to this exact compute demand just as geopolitical risks escalate. Oil prices are climbing ahead of the United States and Iran negotiations in Geneva tomorrow. Everyone is blindly watching the diplomatic theater on television. You need to watch the commercial utility bills. Operating a 6-gigawatt data center requires massive physical baseload power. If crude oil and natural gas spike from Middle East tensions, the operational expenses for every single hyperscaler push higher. That inflation directly compresses the net income of the companies running the artificial intelligence networks. Physical energy always limits digital margins. Tomorrow, we need to watch 3 specific things. Keep a close eye on crude oil futures reacting to the Geneva negotiations. Watch the 10-year Treasury yield for any sudden liquidity tightening. And track the software sector exchange-traded funds to see if today's relief rally holds its ground. This isn't financial advice. I'm Wilson, and I'll see you tomorrow.